Welcome. Happy 2026 to everybody that I haven't talked to on this call, which is, well, most of you. Um, I'm looking forward to tonight's event. This has been something that has been requested from everybody when we do them, and we get really good feedback. And it's just a really great opportunity for us to get Eric out in front of you guys because he is such an integral part to, what you guys see with respect to some of the investment selections that are being made, the portfolio construction, the strategy overall. Um, and it's been really interesting over the past couple of months and years as our relationship has grown to see, you guys asking me a lot of questions that we're already talking about on the investment board, and we're able to give you some really good feedback and answers to some of the questions that, of course, you have. And I make the joke a lot when you guys ask me what you think tomorrow is going to behold, and I give you the, oh, my crystal ball is as murky as anyone's type answer. There's a lot of that going on. And I think the fourth quarter coming into this year, we got more questions than answers in some ways. And this year started off with a bang with Venezuela and Trump pressuring the Fed. So there's no shortage of stuff to talk about. So without further ado, I'm here to introduce Eric Parnell, who's the Chief Market Strategist at Great Valley Advisors and a really good guy overall. So we're looking forward to hearing what he has to say. And I saw his slide deck tonight, and it is quite thin. Usually he's a slide guy, so we'll see what he has up his sleeve. But you know, Eric, thank you again for being here. I know we've been talking about this and just looking forward to kicking off 2026. Talk about what we've been doing on the investment board, about, our thoughts about what's going on in the world, and, answer some questions from the people that, we impact directly. So without further ado, take it away.
All right. Well, thank you, Paul, and thank you everybody for taking the time to join the call, the 2026 Market Outlook call here for Nexa. It's this is my third year of doing this call, and I've really enjoyed the opportunity to speak with you all. Answer the questions that you've had, and no better time to take a look at what we can expect from the markets than the beginning of the year. Here we're second week of January, and it's been an eventful year so far. But I also enjoy these calls because Paul and the work that he does with our investment team, our asset management team. Paul's a member of the GVA Asset Management and Investment Committee. He's also a member of the Advisor Committee, and he is a instrumental part and an invaluable part of the work that we do in providing feedback and basically advocating on behalf of you as the clients and making sure that we're setting the asset allocations and the portfolio models to best serve your needs. So one of the things that's always nice about these calls, it's an opportunity for the internal conversations that Paul and I are having on a regular basis to kind of bring them to a broader stage, and share that with you this evening. So it's look forward to our session tonight. One of the things that I like to say from the outset is that we're going to cover a number of different topics. We're going to talk about stocks. We're going to talk about bonds. We're going to talk about the economy. We're going to talk about some of the geopolitical events that are happening. There's likely to be a lot of questions that you have along the way in terms of some of these topics. Please feel free at any time to just, you can drop a question in the chat if you would like, or you can unmute your microphone and, feel free to jump in with your questions. In addition to working in the investment industry for 30 years, I think I've mentioned it on past calls. I was a full-time college professor for 18 years. So it's the professor in me loves questions. So if you have any questions, please feel free to jump in at any time. But so I'm going to lead off this session here. I'm going to share my screen. And one of the things that Paul mentioned is that, I provided the slide deck, but the slide deck is, a little thin. And part of that is I like to improvise along the way, depending on the topics that we're talking about or some of the avenues that we're on. I may jump right out into the internet and create some slides, some charts that might be useful in terms of putting into context the things that we're talking about. So, we got the core slide slides, but we may go off script along the way, depending on what we're talking about. But with that being said, I am going to share my screen, and I'm going to bring it over here, and then I'll have to turn this into presentation mode. So hopefully, the cameras came through here. My cameras weren't working before, but they all just turned on. This is fantastic. So hopefully, but in front of you, you can see a slide that says the U.S. stock market continues to surge to new all-time highs. And if you don't see that, please feel free to let me know. So I'll begin my presentation in terms of reflecting on my crystal ball to say when we were together this time last year, and something that I was saying fairly frequently throughout 2025 was the fact that the S&P 500, that main headline stock market index, would be surpassed 7,000 by the end of 2025. And you know what? I was wrong. We got close. We basically got up to 6,920 at the end of October. And then we kept knocking on the door to 7,000. Now, we haven't officially crossed 7,000 yet, but I think that's inevitable at this point. Now, it's not like 7,000 that there's something significant or magical about that number, but it's a level that's, kind of psychologically significant. It's one that's a headline grabber. And it really highlights the point that we've had a stock market. You think about the S&P 500, it was trading below 4,000 3 years ago, and here we have it pressing up against 7,000. So it's been a strong market. This is a chart that shows us going all the way back to July. But if we take it all the way back to October of 2022, we had the 2022 bear market, a surge in inflation coming off of the COVID liquidity, the Russian invasion of Ukraine. The markets really struggled in 2022. The stock market did, the bond market did, but since October of 2022, the stock market has performed tremendously well. The bond market, it's been back and forth. We'll talk a little bit about bonds as well, but there's been some other areas of the market that have been notable as well. Good reasons for optimism here as we go into 2026. It's been a good market environment for the last few years, but one of the things, there's a perception among investors sometimes that the market's done so well for these last few years, we're overdue for a pullback. Well, maybe, but if the fundamentals support the stock market doing well, then it's risen for good reason. It's risen for justification. So let's go on to the next slide and talk about some of those fundamentals here. If I can get this to work for me here. All right. So before we get into the fundamentals, I'll get a little bit deeper into that point, though, about, hey, aren't we overdue for the market to correct? It's done so well. Can it continue to keep doing well? Well, the stock market is going to be put to a test in this regard in 2026, because one of the things that's notable, we go all the way back to 1950. So we have 75 years of stock market history. It's a little tough to see with this chart, but if you kind of eyeball it from left to right, one of the things that you'll notice is that, we start over here to the left-hand side, and I don't know if you'll be able to see my mouse or not, but you got 3 strong up bars, then you got a little bit of a down bar. You got 3 strong up bars. You have a down bar. We got 3 out of 4 strong up bars and then a down bar. 3 up, 1 down. And if you continue looking from left to right on this chart, and again, this chart shows the total return of the U.S. stock market as measured by the S&P 500 index. One of the things that we have typically seen throughout history is that if the U.S. stock market logs 3 years of strong total returns, just like we have in 2023, 2024, and 2025, so we have just wrapped up 3 years of strong stock market returns, more often than not, the stock market's going to take a breather in year 4. Now, that has been the historical pattern, but we can't take it to the bank with us, because there have been stretches where we've had 3 strong years and then we get a 4th strong year or a 5th strong year. We take a look in the period in the 1980s here. We had a number of strong years without any bad years. We take a look at the 2010 period up here, where we had many strong years with hardly any down years. So the market can do it. What's the key to make sure that happens? It's the fundamentals. So let's get in and talk about those fundamentals now. And with
And Eric,
that,
one thing I always like to point out when we look at charts like that is
yeah,
we're looking strictly at calendar year windows, right? So if we
absolutely.
were to do measure this, July to July, I bet you the graph would look a little bit different in terms of 12-month windows. So, it's easy. We're humans. We think of calendar years, we think of clean slates, and that's always how the data tends to get presented. But market returns don't happen on a calendar year. They happen in whatever window of time you choose to evaluate them. And if you think about Eric's crystal ball going into 2025, one of the things we were kind of harping on going into the year was the market may be due for a big correction. We don't know what the catalyst is going to be. And sure enough, Liberation Day happened, right? Trump came out with the chart and he was showing everything, and we're watching the futures at night just, sell off by the thousand. And there had to be something that knocked us off the pedestal. And so maybe in that way, Eric, your prediction there was right. But that's always important to remember, is just because we're sitting here on January 15th, that we're setting ourselves up for a loss, because again, this chart is just on calendar year terms, and how you look at the data and the time frames that you look at it in are really important. So it's always nice to have some context around what these charts are actually showing.
Yeah, and that's why I love working with Paul, is because he always brings the good points to the attention. He's absolutely right. There is a fixation with market participants to focus on, how did the market do in 2025? Well, how did the market do in 2024? But it's really not about the calendar year, because, to Paul's point, if you took a look at the market for a 1 year period from July of 2024 through June of 2025, that wasn't a very good stretch for the market, because we had that experience from February to April where the S&P 500 fell by 21%. And I'll go back to this last slide to show it. So we were coming into the year of 2025, and that was one of the things that we were saying, is that the market is overextended, overdue for a correction. We got it early in the year, and then that is one of the things that's healthy about financial markets. Corrections aren't necessarily a bad thing. They help cleanse the market environment. They help cleanse some of the excesses out of the market. Now, this correction that we saw from February to April of 2025 was driven by concerns around the tariffs, and how the tariffs that were being proposed were going to affect the economy and corporate earnings. The one thing that's positive that comes out of these types of corrections is that it gives the market an opportunity to reset. It provides cleansing. We saw the same type of thing in a much smaller scale. We got up to October 29th, right as the stock market was about to press above 7,000. And then we had a pullback through November 21st. Took 400 points off the S&P 500, helps cleanse the excesses out of the market and set that foundation for the market to take its next step higher, which is one of the things that we're seeing here as we go into the new year. So let's talk about those fundamentals. Do we have justification to expect that the U.S. stock market can put in another solid year of returns in 2026? Now, one of the things that I'll say going right off the bat, we had double-digit returns in the S&P 500 in 2023, 2024, and 2025. It's been fantastic. Will we get double-digit positive returns in 2026? That remains to be seen. I would say base case expectations, at least from this chief market strategist going into 2026, is that it would be a great year. It'd be a rock solid year if we got high single digit to low double digit returns on the S&P 500, something in the range of 7% to 12% positive returns. But that's good stuff. That's a market that's had a bunch of good years and basically has the ability to push forward. So what's the reason behind this forecast? Because there have been years we're going into it to say, hey, this could be a tough year. It's not setting up to be a tough year, at least going into the year. What is the primary driver of stock market returns? It's economic growth. And one of the things that has been true when we went into 2022 and 2023 and 2024 and 2025, the consensus view for the economy, not my view, but the consensus view among economists was that we would see an economic recession in the second half of the year. That was the consensus view in each of the last 4 calendar years, but it never came to pass. The U.S. economy has proven to be much more resilient than expectations over the last 4 years, and we're continuing to see that trend going into 2026. There's been a lot of concern in 2025 about the weakening job market, the weakness in manufacturing data, these pockets of weakness that exist in the U.S. economy, but the actual data isn't reflecting that. And if here we take a look at, this is one of two forecasts that we follow. It's the New York Fed Staff Nowcast. It's an economic forecast that comes from the Federal Reserve Bank of New York. So this is an independent agency. This is not tied to the U.S. federal government or anything like that. This is a Federal Reserve regional bank in New York City, which is the most important of the 12 regional banks that's tied to the U.S. Federal Reserve. They are projecting for the first quarter of 2026 economic growth north of 2.5%. If you can get 2.5%, that's an economy that's expanding. And more often than not, if the economy is expanding, the stock market wants to go higher. So, and if you take a look at this area on the right here, this is what we refer to as the normal distribution or the expectations of outcomes. You can see the shaded areas in terms of, based off of the data, what we can expect from the U.S. economy here in the first quarter of 2026. Basically, 95% of forecasts has an economy that is growing at a solid rate. It is the foundation for higher stock prices, regardless of valuation. And we have an economy that's looking to continue to expand in 2026, despite some of those concerns. All right, so why is economic growth so important for higher stock prices? Because economic growth, if GDP, that gross domestic product, that number that you'll hear about in the news, what does that measure? It's measuring total output in the U.S. economy. And if output is increasing, that means companies are making more products, and presumably they're selling those products and they're making more money in terms of corporate earnings or profits. If corporate earnings are rising, then stock prices more often than not, and there's a very high correlation between growing corporate earnings and rising stock prices. So let's move past the Federal Reserve Bank of New York, and now let's just take a look at the aggregate of the 500 companies that make up the S&P 500 index and what they're forecasting for earnings in the coming year. On the left-hand side, we have the 4 quarters of 2025 and the last quarter of 2024. We saw strong earnings growth, double-digit earnings growth all through 2025. And this is and we know how well the stock market did in 2025. Companies are forecasting just as good, if not even better, earnings growth for 2026. If earnings growth is rising, more often than not, stock prices are going to push to the upside. So raises the question then, say, okay, well, why high single digit to low double digit growth in stock prices as opposed to something greater? It's because the stock market has done so well up to this point. There is a valuation component. How much are investors going to be willing to spend at this point for each dollar of earnings, your PE ratio or price to earnings ratio. And stocks have gotten pretty expensive in certain pockets, but there's also areas where they're fairly attractively valued. And that's part of what we'll break out here in a little bit. So a fundamentally strong outlook for stocks, all else equal, heading into 2026. And before I go into some other topics, I just wanted to see, are there any questions at this point in terms of, what we're seeing here in some of these initial charts?
Yeah, feel free to unmute yourself or type something in the chat.
Hi, Paul. This is Steve Zerio.
Hey, Steve.
Happy New Year, even though it's too late to say that. Are these industry selective or industry neutral?
No, that's a great question, Steve. So basically, they're sector weighted by their percentage size in the S&P 500, and you're highlighting a good point that we're going to talk about. So I think it's worth to get into it now. One of the things that we've seen over the last several years, the stock market performance in the S&P 500 in the U.S. has been fairly concentrated. A lot of the strong gains in the U.S. stock market have come from 3 sectors: the technology sector, the communication services sector. Think Meta platforms or Facebook. Think Google or Alphabet. Their names. Meta's Facebook. Alphabet's Google. And also consumer discretionary, which is really headlined by Amazon and Tesla. Those are the areas that have really driven stock market performance, those three sectors over the last few years. And part of that has been justified. The technology sector has experienced phenomenal earnings growth over the last few years. And as a result, it has grown as a percentage of the S&P 500. But one of the reasons to be really constructive as we go into 2026 is that there are other areas of the U.S. stock market that are also showing strong earnings growth that have really not participated in the upside of the market up to this point and are trading at their most attractive valuations that we've seen, in the last 10 years or longer. And for that, I'm going to jump off of here. I'm actually, here's the first audible of the night. I'm going to jump off of here and I'm going to come over to a different section here. I'm going to share my screen with you now, and I'm going to share it on a different level here to better answer the question. We're going to share. And I will come in here. So I'm coming into some live charts here. So this is the source of some of those charts that we saw earlier. And I'll start here by, we'll throw in the technology sector, which is, we'll use XLK or the State Street technology sector. Here we see the strong performance of technology stocks over the last year and a half. And a lot of that's been justified by strong earnings growth. But let's take a look at the second best growing sector in the S&P 500 over this same time period. It's not communication services. It's not consumer discretionary. It's healthcare. Healthcare has been growing at a +20. It's been growing earnings at a +20% rate over the last 18 months, over the last 2 years. But let's take a look at its price performance over the same time period. It's been lousy. You go back to September of 2024 all the way through to August of 2025. Healthcare stocks were effectively in a bear market despite the fact that they were growing earnings by north of 20%. So, it kind of raises that question for some investors to say, okay, well, why are we owning healthcare stocks when technology is doing so well? Because the fundamentals are there to support higher stock prices. And that patience was rewarded during the period from August all the way through to the beginning of 2026, because we've seen a sharp rally in healthcare stock prices. And that's been driven by the fact that there are strong earnings that exist in that area of the market. So this chart that we're looking at here, and I'll come back to that chart again that we were looking at before, although technology stocks are a good supporter of the strong earnings forecast, one of the reasons that we're constructive on markets going into 2026, you always hear that expression, the Mag 7, and the 7 stocks in the S&P 500 that make up such a big part of the S&P. Well, we're still constructive on those technology stocks, but we're also constructive on the S&P 493 that are showing good earnings growth and maybe haven't participated as much up to this point. And they're all reflected in this number and on this chart. All right. So any other questions at this point? And Steve, did I answer your question on that one, or is there any other areas that you'd want to delve a little deeper?
That was helpful. I mean, that explains a lot. You hear so much with the tech stocks driving everything, and the expected bubble regarding, say, NVIDIA and whatnot. How much of that is impacted in there? I think you gave me a good look at it.
Okay, good. Yeah, and that's really one of the keys is that the market broadened somewhat in 2025. It really started to broaden a lot more. And when I say broaden, I mean that there's other areas of the market other than technology that are doing really well. We saw a fairly significant broadening. In any given year, you would expect roughly 50% of the stocks to outperform, 50% of the stocks in the S&P 500 to outperform the S&P 500. what in 2024, only 21% of stocks outperformed the S&P 500. That was the big Magnificent Seven year, this big tech stock year. In 2025, it was better. 34% of stocks outperformed the S&P 500, but I mean, a third is much less than a half. So we've seen this big concentration of returns, and the pessimists would hear that and say, "Oh, okay, if those stocks that are leading the market, if they stumble, it's going to bring the market down." And sometimes that's true, but there's a reason to be optimistic and constructive as we go into 2026 on this front. In the fourth quarter of 2025, 46% of stocks outperformed the S&P 500. We had more stocks, and a lot of them were outside of the technology sector that were outperforming the S&P 500. And so far this year, and it's only a couple trading days so far, but so far this year, we're seeing over 60% of stocks outperform the S&P 500, and most of them are coming from sectors outside of technology. That's broadening, that's healthy, and that's a good reason for constructive enthusiasm going into the coming year.
And Steve, if you guys had a chance to read my fourth quarter market recap that went out last week, one of the things I highlighted was exactly that concern is, is the concentration risk going to drag portfolios down if tech stumbles? And, of course, the outsized weight lends it to a greater risk of that. But you saw the fourth quarter where virtually all the technology stocks underperformed the market in general, where tech was generally negative for the fourth quarter, yet somehow the S&P eked out a positive fourth quarter. So you can have that disparity in performance if the S&P 493, as Eric likes to call it, continues to perform, even despite some, the anchor of tech stocks underperforming for a period of time. Of course, we don't want to see that, but it can happen. And that's one of the things that we saw in the fourth quarter that kind of got us excited that, those stocks still exist and can have a material impact on market returns in general.
I did read it, Paul. I read everything you said.
There you go. Smart man.
It's a lot of good content that Paul puts out, so I enjoy reading it myself. So Linda had a good question about stocks versus bonds, and it's a good opportunity for us to kind of to pivot here. And for that, I'm also going to come back to these charts here, because one of the things that we've seen since 2022 is a different environment for the bond market than what we've been accustomed to for many of our lifetimes. I can still remember. I was a young kid at that point, but I remember my mom taking me to the bank in 1981 to open up a savings account, and I was getting 14% interest on my passbook savings account at the local bank in 1981. It was a very different time coming off the 1970s. And for that, I'm actually going to pull up a chart here just to kind of show where we've come to versus where we've been. So here's a chart of the 10-year Treasury yield, which is a reflection of the bond market. And so we only capture the very end of 1981 on this chart, but you can see 15.84% yield on a 10-year Treasury bond. Phenomenal. And one of the things with bonds, as bond yields fall, so this is a chart of bond yields. As the yields fall, that means bond prices rise. So one of the things that we see from 1981, which is at the beginning of this chart, all the way through to 2020 and even 2021, it was a fantastic time to own bonds. Bonds were basically increasing in value year after year after year. And they provided a tremendous ballast and a tremendous diversifier against stocks in a portfolio. So you think about the 60-40 portfolio, the one that we all hear about, 60% stocks, 40% bonds. When was the advent of the 60-40 portfolio? It came around the time of the 401k plan starting to be introduced to replace corporate pension plans. When did that start to take place? In the early 1980s. So this whole idea of 60-40 and this whole idea of like owning bonds to diversify against stocks, it's because bonds were basically gaining in value year after year after year on a price basis. Plus, you got a pretty nice coupon payment, that yield that you're showing here. So it was a great diversifier from 1981 all the way through to 2021. But then we come over to the right-hand side of this chart here, and basically, I'll zoom in here so we can see it a little bit better. We are now in a different environment for bonds than we have been in the 40-year prior, from 1981 up through about 2021, 2022. So let's take this from 2021 to 2022. And we have seen a meaningful increase in treasury yields going all the way from less than 1% going into 2021, all the way up to 5% in the end of 2023, and then kind of bouncing back and forth between about 3.5% and 5% since the beginning of 2023. We're in a different environment for bonds than we've been in the past. And there's a reason for that. The reason that is, and this is a healthy thing. This is a good thing for markets. We don't want a 10-year treasury yield that's yielding less than 1% because it's hard for people to generate high quality income. It's a much healthier market environment when you have treasury yields that are in the 4% to 5% range, because it's exceeding the rate of inflation and it's providing a good way for people who are in retirement or heading into retirement to generate reliable income. So this is a good thing. But from a portfolio diversification standpoint, we need to think about the bond market a little bit differently, because really its performance over the last 5 years. Now, 2025 was a good year for the bond market, but it's kind of been a mixed bag here in recent years. We need to think about the bond market differently going forward. And the way that is that we may not see treasury yields come back down in the future. And part of the reason I'm just going to stay here, and I'll pop the chart up here to show it, is that the expectations around inflation are different than what they've been in the past. From all the way from the 1980s, we came off that period in the 1970s and the early 1980s where inflation, we had that stagflation problem where we had high inflation and low economic growth. But from 1981 all the way through to the early 2020s, inflation was steadily falling and was staying low. And that's a great environment for bonds, and that's a great environment for bonds to fall, for bond yields to fall, and for bond prices to rise. Let me get the chart up here. I don't see it here, so I'm just going to have to do it this way.
And one of the things that we've been talking about on the investment board, and this is nothing new from a, we'll say, portfolio construction standpoint, but Eric referenced the 60-40, which is the kind of the benchmark portfolio that you would talk about for diversification, and that used to be 60% stock, 40% bond. Now that is kind of changed a little bit, at least in our eyes, and we look at it as equity and non-equity, and non-equity doesn't necessarily mean bonds. So if you have a 60-40 target for your portfolio and you look, your equity, your stock, between domestic and international should be roughly 60%. But the 40 is not going to be all U.S. Treasuries or corporates or whatever it is, the ag. You're going to see things like gold in there. You're going to see hedged equity. You're going to see commodities. You're going to see real estate, pieces of the investment world that have that low correlation, Linda, that you were referring to, that will act differently than the stock market and, potentially provide you with a little bit of a buffer. Like, think back to April of last year. I got a lot of comments like, hey, this isn't as bad as I thought when I looked at my statement. It was because of that non-equity piece, and honestly, the international piece too, which we'll talk about. But having a little bit of diversification outside of just the basic stocks and bonds has really been, a boon to the bottom lines of portfolios. And one of the positions that we've held for a while is gold, which was up, what was it, 60 some odd percent last year, which is just crazy. But it's been a really nice thing to have a real tangible hard asset in the portfolio that's provided, in this case, some extra alpha, but even in bad years, it should have that non-correlating factor that we look for when we're constructing a portfolio.
Yeah, no, Paul raises such a good point that I jumped over here to another chart because I kind of want to build on that. Is, we think about stocks and we think about bonds, and for bonds, I'm gonna use a security in here that kind of highlights it. I'll change this to SPY, or actually I'll change it to SPYM. And I'll use a measure of bond market returns here, and let's go to 2025 here for that, 2025. So what this chart shows is the cumulative return for stocks and for bonds in 2025, all the way through to the beginning of 2026. And we see the diversification benefit here. So Linda, this gets back to your great point about how, in 2025, we kind of saw a return to normal. And part of that is that we have bond yields that are higher, and you don't need to take on as much risk in order to get kind of that guaranteed return from U.S. Treasuries, or, that coupon return from bonds, because that's makes up a bigger part of the total return. In the beginning of the year, the black line is the S&P 500. And we saw that big correction here from February 19th all the way through to April 7th, where the S&P, in total dropped roughly 21% of its value. The diversification benefit of bonds. Now, less exciting than stocks, but rock solid nonetheless. We saw, the bond market up around about 7%. As the U.S. stock market down 21%, the bond market up 7%. So that diversification factor coming into play here, and remain consistently solid back and forth through the remainder of the year, generating a return. And actually, instead of TLT here, I can show something a little bit better. But I'll just keep this up here. It's good representation of the bond market. Bond market providing a rock solid 6% return for the year, and providing diversification when the stock market was down. We've seen a return to that. But we want to diversify beyond just bonds going forward. And that's something we've been doing for recent years. As Paul mentioned, we view it as equity and non-equity, because it's not just bonds that can diversify against stocks. It's a variety of other asset classes that can do it as well in a different way. And one that we've had as a dedicated allocation in our portfolios has been, and I'll add this down here now, is the allocation to gold. And we'll bring this into play, and hopefully that got added to the chart here in my view. So this is what we refer to as low correlation. We have three different investments: stocks, bonds, and precious metals, as shown by gold. And one of the things, they're all moving independent of one another. Yes, stocks were down, bonds were up. And gold had a fantastic year here in 2025, had a fantastic year in 2024. So we see how well gold did in 2025. Let's add 2024 in here to show. Stocks and gold both did really well in 2024. In the beginning of 2025, stocks weren't doing well and gold was doing well. And then when stocks regained their footing, gold continued to do well. So this is a security, a kind of what we refer to as the third leg of the portfolio diversification stool, that was performing well regardless of how stocks were performing at any given point in time, regardless of how bonds were performing at any given point in time. And you put these three together into a portfolio, what you get, still strong returns, but with much greater consistency and with much less risk, because you can basically draw a line between, now there's a much greater allocation to stocks than there is to bonds, and definitely to gold, but you can draw a line through these different lines that are moving back and forth to provide a much more consistent experience. Now, so that's one of the things we've seen. Now, another area of diversification, the U.S. stock market has been the place to be for 15 years. I'm going to show a comparative return chart here, 2010, 01, and what we'll do, let's take this through to the end of 2024, 12/31. So this is 15 calendar years. We're going to take the S&P 500 index, and we're going to compare it. And actually, I can use another one here that will show it. And we're going to compare it to two other areas of the stock market. We're going to compare it to developed international stocks, and we're going to compare it to emerging market stocks. So this chart that you have in front of you, this goes back to the beginning of 2010. U.S. stock market is measured by the S&P 500, up 600% cumulatively over that 15-year time period from 2010 to the end of 2024, versus just over 100% for the blue line, which is developed international stocks, and less than 50% for emerging market stocks, which is the red line. So in looking at this 15-year experience, the conclusion that an investor would naturally come to is that, well, I should just invest to the U.S. I shouldn't bother with developed international or emerging stocks. Why would I want to do that? Because look at the strong 15-year performance of the U.S. stock market. Well, one of the reasons that you want to allocate to international and emerging is, let's take a look at what we've seen since the beginning of 2025. And we'll take this all the way through to today. What have we seen here in 2025? We've seen developed international stocks up 36% in the blue line. We saw emerging market stocks up 42% in 2025, the red line, versus the S&P 500 up 19%. We saw these two international markets, developed international, so think like the UK, France, Germany, Japan. Emerging markets, think China, Brazil, Eastern Europe. Performed significantly better than the U.S. stock market. Now, you could look at this and say, well, wait a second. You just showed me a chart, 15 years of strong performance from the U.S. stock market. You're going to show me 1 year of strong performance from these international markets. Maybe this is an anomaly. Maybe this is just a blip. Well, it's not likely to be that. This could be the beginning of a trend that could last through the end of this decade and into the next decade, because the primary determinant of international and emerging stock returns for a U.S. investor is the direction of the U.S. dollar. And one of the things I'm going to pop up here now is I'm going to pop up a chart here. If I can pull it up here quickly, we're going to show a chart of the U.S. dollar, and I'll make it bigger so we can see it. A U.S. dollar chart, and going all the way back to 1988, and we could take this back even further. Now, I mentioned
and
before,
for you avid travelers out there, this kind of hits home, especially those that got to travel abroad a couple of years ago and go over to Europe. When you remember the dollar and the euro were almost at parity, meaning $1 equaled €1 almost. It got to within a couple of pennies of it. And there was a point when it was far different. So when we talk about the dollar strength, that's a real world example of how that changes. And the exchange rates change year to year. It could be $1.20, could be $1.60. And that really has a huge impact on how securities are priced and how their earnings are translated into US dollars. Because if you need less foreign dollars to equal one US dollar, that makes it a more attractive investment. And that's kind of what this convoluted green line is showing when you think about how it affects your pocketbook and how investors are pricing things, relative to an example you may be a little more familiar with.
Yeah. So, I mean, and, if you traveled outside of the US 15 years ago, you may have found it pretty expensive because the US dollar was notably weak relative to global currencies. And that's what part of this chart is showing here. This is a chart of the US dollar index going all the way back to the beginning of 1988, all the way through the present. So we basically have a 10, 20, 30, 40 years, it's hard to believe, a 40-year look at the US stock market going back to 1988. I mentioned before, U.S. stocks meaningfully outperforming developed international and emerging stocks during the period from 2010 to 2020, the end of 2024. Well, let's go to the beginning of 2010. Where's the U.S. dollar index? It is really weak relative to the rest of the world. And it made it really expensive to travel abroad coming off, in the years following the financial crisis. Where were we at the end of 2024? The US dollar was very strong relative to global currencies. The strength of the US dollar is the primary determinant of developed international and emerging market returns. One of the primary reasons that US stocks did so much better than developed international and emerging stocks from 2010 to 2024 is because we saw this massive strengthening of the US dollar relative to global currencies. Got all the way up to 109.96. On average, the US dollar is at about 94 in the US dollar index. It runs at about 94. We had a phenomenal year for developed international and emerging stocks in 2025, and that was a byproduct of the US dollar weakening from 109.96 on the index to 99 on the index. The long-term average is 94. And we think it's very reasonable to think that over the next 2 years, the US dollar is going to continue to weaken relative to global currencies. So we could get down to 89 or even less over the next 24 months. And if you go back in time to when did developed international emerging stocks do much better than the US? Well, from 2001 to 2010, and this actually goes all the way back further before 1988. It was basically all the way from 1983 all the way to 1995, during periods where the US dollar weakens. If the US dollar is weakening, that favors developed international and emerging stocks. If the US dollar is strengthening, 1995 to 2000, 2010 to 2024, US stocks doing better than international. We are very likely at the beginning of a dollar weakening trend that could last through the end of the decade. So if anything, and we maintained a dedicated allocation to international stocks, developed international and emerging stocks, and we have been increasing our weighting in your portfolios to those areas of the market, not only because the fundamentals are improving outside of the US, but because it's our expectation that this recent dollar weakening that we've had may only just be getting started over the next few years.
And this really should come as no surprise, too, because you've heard what the administration in Washington has been saying, and Trump has wanted a weaker dollar since his first, term as president. So he wants that because that makes our goods and services cheaper to overseas buyers. And there's a whole world out there that wants to buy our stuff. So this is something that is very consistent with his agenda and that he's been vocal about. So, I think this is kind of delivering on one of the promises that he wanted as president to make us a little more competitive on the global stage with exports.
Yeah, no, absolutely. So, to Paul's great point, we've been hearing that out of the administration. Basically the themes from a political standpoint in terms of fiscal policy are things that typically lead to a weaker dollar. We've also been hearing about the Federal Reserve cutting interest rates, and we're likely to have a new Fed chair come May 15th. And it's very likely that we're going to see some additional rate cuts from that new Fed chair after May 15th if we don't get more rate cuts before then. Those are also factors that lead to a weaker dollar, all else equal. So there's a variety of forces that are coming together that suggest a weaker dollar. So we have been increasing, and we already had a dedicated allocation to developed international and emerging stocks going long before 2025, and we have been gradually increasing that weighting with the expectation of a weaker dollar. Now, there's additional element that goes into this, and I'm going to pop back to the other chart that I popped up before, is that with a weaker dollar, with stimulative fiscal policy, with stimulative, which is increased spending from the U.S. government, with stimulative monetary policy, which is lower interest rates from the U.S. Federal Reserve, we should expect higher inflation from that to come from it as a result. And this is kind of reflected in this chart. Ever since COVID, inflation that used to kind of rattle between, and I apologize for the highlight lines I'm getting here, but inflation that used to rattle between 1% and 2% during the post-financial crisis period all the way up to COVID is now bouncing between 2% and 3.5% in the years since. Inflation expectations are higher. And if we get stimulative fiscal and monetary policy, they may be higher still. Now, that can be challenging for the bond market, but it's not necessarily a bad thing for the bond market, because what you can do with your bond investments is you do what's known as shortening duration. You own bonds that are going to mature sooner, like 1 year, 2 year, 3 year, because you can collect that coupon, that higher interest rate, that higher yield, but you're eliminating the price volatility. So it's one of the things that we're doing on the bond side, is that we recognize the risk for inflation's higher. We recognize that could be, a little bit more challenging for the bond market. So what's doing is shortening duration. We're owning bonds that mature sooner and out in the future, a year, 2 years, 3 years, collecting that higher yield and reducing the price volatility, so we can still generate a positive return and a solid positive return from the bond market. So even though we may be could potentially see some higher inflation going forward, adjusting bond portfolios to not only capture that higher yield, but capitalize on that if that's the effect that we end up seeing.
So speaking of inflation, and I know we're getting close to time, but at the risk of sounding like a broken record, we've been saying that one thing that could really derail this whole, bull market that we've been in is a unexpected and drastic renewed rise in inflation, because that will put the Fed in a real bind and have to force them to possibly tighten again. And, I guess, Eric, if you could answer or respond to that, is that still your number one cause for concern going into this year?
Yes, I've been saying it since the summer of 2023, and it's just like it's like Chicken Little, but it's with purpose. Just because something's a downside risk, and I'm noticing something here, and it's going to drive me crazy, so I got to fix it and go back to 2026 outlook. It's like when you write a check and you put 2025 into it. Inflation continues to be the number one downside risk for financial markets as we go into 2026. That doesn't mean it's going to manifest itself at all. Because if you think about that chart that I just showed you, and actually I have it in this deck here, although inflation may be the primary downside threat to markets, it doesn't mean that it's going to actually happen. It's like you buy auto insurance, and the primary risk when you go out and drive is that you're going to get in an accident, but that doesn't mean you get in the accident. Inflation expectations continue to be fully in check as we go into 2026, and this is a very positive sign. But this is something that's worth watching as you go through 2026, is that if we see this line start to rise the way we saw it rise in 2022, which you can see on the left-hand side, 2021 and 2022, which you can see on the left-hand side of the chart, that would signal to you that, okay, this risk that Eric Parnell has been talking about for the last few years is actually starting to happen. And it may not happen. And if you're interested in monitoring this as we go through the year, all you have to do is you go out to Google, you type in 5-year break-even inflation rate, and it will take you right to this chart. And as long as it continues to look like this, where on the right-hand side, it's been trending lower and it's at 2.3%, the stock market will love that all day long, and that risk will remain completely contained. But it's something that we want to continue to watch as we go through 2026. I would say the more immediate, although I would continue to say that's the number one downside risk to markets going into 2026. And the reason that is because, the bond market will be challenged by higher inflation, and stocks also get challenged by higher inflation, because it means that the corporations will have trouble earning money because they have to pay higher costs in order to produce their products. So it causes corporate earnings to shrink, which then causes stock prices to fall. The other challenge with high inflation is the Federal Reserve cannot cut interest rates to combat the economic weakness that comes with higher inflation. They basically have to fight the inflation problem first. So at this point, although it is the number one downside risk for financial markets going into 2026, it's not one that is presenting itself as a problem as we enter 2026, but one that's worth watching. I would say the bigger risks as we go into 2026 would be, we've had the solid economic outlook, we have the strong earnings outlook. So, and that's helped justify higher stock prices, and it's helped justify higher valuations in the stock market, particularly among those tech stocks. If we hit a threshold in 2026, it has been an artificial intelligence AI boom party in the U.S. stock market going all the way back to May of 2023, and that enthusiasm is completely justified. The artificial intelligence will change the world over the next 25 years, the same way that the internet in the late 1990s has changed the world for the last 25 to 27 years through today. It's the whole reason that we're here talking today, is because we can get on the internet and do all this. So the fact that it is transformative is not in doubt. But the one question is that how much has that been priced into the market at this point? We have seen phenomenal stock price performance among these stocks that are most completely tied to AI. And what helps justify their continued rise is even more earnings and even more capital expenditures and even more interdependence in all these companies working together to build this AI network. It doesn't take much after stocks have performed so well for so long, particularly when it comes to technology. Even if it's just that rate of growth starts to slow, or the gross margins that they generate and the earnings that they generate from all the spending that's taking place, it starts to flatten out a little bit. That's all investors need to kind of pull the plug on that, some of their AI stocks and pull it to the downside. The other thing that we have to watch in 2026 from the AI side, the earnings forecasts are phenomenal. Can these companies meet these phenomenal expectations? And is it a situation in 2026 where we start to reach a point where the rubber has to hit the road, where these companies that have spent so much, do we start to have to see winners and losers? And if there are companies that lose and start to fall out of the AI race, does that start to pull down some other companies with it because they're not spending that money anymore? Is it just do we reach a threshold where it simply can't grow anymore? That's another thing that we need to watch as we're going through 2026.
Great. And, as we come to the close of this is the popcorns session, part of the session where, we ask you guys just to throw whatever questions you might have at Eric. And Steve, I see you have one in the chat here that we'll get to quickly. But if anyone has anything else you want us to talk about that we haven't, this is usually where someone asks about Bitcoin or silver or, God knows whatever the hot topic on TikTok is for financial advice these days. But, we're here to answer those as well. But Steve has a good one that we really didn't touch on, and that's about geopolitical issues. And of course, we have a lingering conflict in the Ukraine. We have the whole thing with Venezuela. We have a protectionist administration. So, Eric, what's your take on that?
Yeah, no, that's always a good thing to think about is what's the geopolitical risk for financial markets. And, basically that'll always loom out there as a risk, but it's almost always a short-term risk. You have some geopolitical event that takes place, the market will pull back for a few days, and more often than not, it will find its footing. And in some cases, will end up even higher than it was before that geopolitical event. More recent examples, when the situation between Israel and Palestine broke out in a couple years back, market was down initially, quickly found its footing, and moved to the upside. That is the typical market response when we have a geopolitical event. You'll have an initial pullback, the market finds its footing, and then we'll quickly move to the upside. If anything, it's a buying opportunity for markets when you have a geopolitical event. And to highlight how this typically works in even the most extreme cases, I'll take you back in time to one of the most profound and significant economic events of our lifetimes, geopolitical events of our lifetime. And it was the events of 9/11, basically. And I'll pull up the stock market chart here, and it kind of highlights, and actually let me take, okay, so this will capture it. It was 2001 was a tough year for the markets. The market was declining coming all the way into 9/11. Actually, I got to zoom in on this a little bit more just to highlight it best. But let's get here. Let's go 9/1, and let's go to October 30th because that'll help us see it better. All right. And thinking about geopolitical concerns and the potential impact on financial markets, I got to get rid of that legend here as well because it's blocking the screen. All right. So we have a market, it's declining. It was a tough start to December in 2001 because we were in the middle of the bursting of the tech bubble. And market was higher on the Monday before 9/11, and then 9/11 happens. The geopolitical impact of that event, a terrorist attack on the United States, was so profound that it shut the U.S. stock market down for a week, and it didn't reopen again until the 17th. So this is an attack on the U.S. financial system, the most profound geopolitical event. Stock market dropped for 5 days, but then it bounced. And by the middle of October, the U.S. stock market is trading higher than it was before 9/11. If the U.S. stock market can be that resilient that is trading higher after the attacks of 9/11, 1 month later, or even going back even further in time, when did the U.S. stock market bottom after the Great Depression? It's the U.S. stock market bottomed in April of 1942. An even bigger geopolitical event, the outbreak of World War II. We had the uncertainty. We didn't know who was going to win that war. It's 1944 when we landed in Normandy. Yet the bottom for the stock market during that time period was April 1942, and it moved steadily higher through all of World War II. So I share that historical framework. It is very easy when a geopolitical event occurs to think like, oh, I mean, the market's not going to be able to handle this, and it could take it down for a while. History has shown time and time again that it can overcome those geopolitical events and move higher, even during the tech bubble where there was all these forces that was pulling stocks to the downside. But that's a great question because it's something, despite that reality, it's something we continue to watch because those geopolitical events, they affect economic responses, they affect market responses, and they can also impact corporate earnings. But more often than not, it's more of a buying opportunity than anything else.
Thank you.
So I see Wayne is typing, but I don't know if there's any other questions that people want to unmute their microphone for when that we can add to the discussion. So, all right. So Wayne has got his question in here. So it says, Eric, what is your thoughts on the midterms in 2026 and changing of the Fed chair impact? That is a great question, Wayne, because one of the things, and this is my own chief market strategist view. I have been covering the Fed and following the Fed going all the way back to the Alan Greenspan days. I still remember where I was during the stock market crash in 1987. I remember the Paul Volcker days of the Fed and learn, have a perspective on that. Fed independence is absolutely critical for the proper functioning of financial markets. You need to have those that are leading monetary policy. It's the most powerful position in the world because you control the U.S. currency and the availability of the U.S. currency. So the independence of that role is so critical. And the Fed has come under a lot of political pressure in recent years. And we have seen the consequences. If you take a look at countries like Turkey or Brazil or other countries, where their central banks and their monetary policymakers lose their independence, the outcome is never good. We've even seen it in the United States. And just to give you a bipartisan view, the Johnson administration put a lot of pressure on the Fed, so Democratic Johnson administration, the Republican Nixon administration put a lot of pressure on the Fed to keep interest rates lower than they should have been during the 1960s into the early 1970s. And many of us can remember, or at least learned about how that played out during the 1970s. It was a disaster. We had higher inflation. So one of the things that we're going to need to watch as we go through 2026, we may learn who the next Fed chair is going to be. Once the Fed chair is in that position, clearly there's going to be an expectation that the new Fed chair will be lowering interest rates, but that doesn't mean that's necessarily going to happen. And that's one of the things we're going to want to watch. If you take a look at the poly market odds right now, the leading candidate to be named as the next chair of the Federal Reserve is Kevin Warsh. Kevin Warsh served on the Federal Reserve Board back during the Ben Bernanke time as Fed chair. And he was somebody who was very hawkish on monetary policy and was kind of resistant against quantitative easing and all of the stimulation to stimulate the economy. That doesn't mean that he'll maintain that hawkishness going into that job. But these are people, many of the candidates, not all of them, but many of the candidates for the Federal Reserve chair are people who are experienced central bankers. And one of the things that there's going to be a lot of talk around the expectation that the Fed lowers interest rates once that new Fed chair is in place. In maintaining that independence, whether they're allowed to maintain that independence, we have to look no further than the Treasury Secretary under the first Trump administration and the second Trump administration. Although he has been hands-on in a lot of other areas of his administrations over the last, his 5 years as president, under his first term, he had Steve Mnuchin as Treasury Secretary for 4 years, and he basically left him alone to do what he needed to do to run the Treasury. And with Scott Bessent as his Treasury Secretary now, in many respects, he looks to the counsel of his Treasury Secretary in terms of making economic decisions. One hopes that the next Fed chair will be granted that same respect and that same independence. Only time will tell. With that being said, if it is a situation where the new Fed chair gets in there and is succumbing to the pressure of lowering interest rates when that's not needed, well, that whole number one downside risk to the financial markets being inflation thing could become a problem really, really fast. So that's another thing. It's May 15th, 2026 when the new Fed chair gets in place. And that's something we're going to really need to watch closely as we go through the coming calendar year. Just to build on your point there too, Wayne, about the midterms. Those fiscal policy outcomes, whether the Republicans, Democrats control the Senate, control the House, control the White House, unless it's a situation where you have, a unified control, Republican control the White House, the Senate, and the House, or Democratic control of the Senate, White House, and House, the market typically responds well. If it's gridlock, the market likes gridlock. The market likes it when Washington isn't getting involved in the things that they're doing in financial markets. It can also get excited if it has one party control, because that means they might get the tax cuts that they're hoping for. They might get the fiscal spending that they're hoping for. Markets do a pretty good job of adjusting to elected official outcomes, regardless of what side of the political aisle it lands on. So I see the outcome of the 2026 midterm elections to be much less of a downside risk, and could potentially be an upside risk depending on how it plays out.
Thank you, Eric.
Thank you, Wade. So are there any other questions that people have as we make our way here into 2026? A lot of great questions here tonight.
And as you guys know, there's an open line of communication to our office. And if you ever have anything, ask me something that I can't answer, I know a guy who can. So I'm happy to make that call on your behalf and get Eric involved if it's something that's above my pay grade. But I think these are just helpful to level set expectations, because we know there's a lot out there that you're reading and seeing and honestly just feeling based upon conversations you're having with, it could be coworkers, it could be family members or friends, and everybody has their own relatively strong opinion about the world and how it operates and works and how financial markets work. And some really like them, some are scared of them, some think that they're a Ponzi scheme. So, you just got to be careful and try to find some reliable information. That's one of the reasons I like that Eric just goes to, the Federal Reserve website, stock charts. These aren't proprietary things that we're cooking up before we put these things together. We're using real world data that you guys can, vet and have access to on your own, and, are often the items that a lot of our policymakers are using to make the decisions that they make to run this country. And institutional investors are looking to when they're making decisions. So, that's why we do these. We're going to continue to do them until you guys tell me you don't want to do them anymore. So if anything, we get more and more people that watch these, or the replays, or the sound bites that we put out afterwards. So I appreciate your continued engagement. Means a lot to be able to help you guys and give you the guidance and have the trust that you place in us. And it's always a pleasure to start off the new year with Eric and have these conversations, and just look forward to having more of them as time goes on. So thank you all for spending your Thursday night with us, and go UConn Huskies.
Go Huskies.
Thank you.
That's right.
Ciao.
Take care, everyone.
Thank you so much, everybody.
Thank
Bye-bye.
you. Bye-bye.
Bye.